Welcome back to America Decides. Thanks so much for staying with us. You're going to be very glad you did. As we've discussed, President Trump announced today, midday, that he's raising tariffs on China to 125% and then pausing reciprocal tariffs for all other countries. There's an asterisk there. I mentioned it earlier. 10% baseline tariff rate applies to everywhere. Here's how the president defended what can only be viewed as a pivot today.
We don't want to hurt countries that don't need to be hurt, and they all want to negotiate. The only problem is, you can only do so many at one time. We want to do it right. We want to get it right. We want to take care of them, but we have to take care of our country.
Neel Kashkari joins me now. He is the president and CEO of the Federal Reserve Bank of Minneapolis. Neel, boy, it's great to have you with us on this day. You wrote a piece this morning. Lots of people were reading it and talking about it. It carried the headline, Potential Implications of Announced Tariffs for Monetary Policy. How would you rewrite that now?
Well, it's good to see you, Major. Obviously, things have changed quite dramatically this afternoon with the president announcing the 90-day pause. I focus on two main elements in my piece. One was the size of the tariffs that had been announced, and that's now, at least temporarily for 90 days, been revised lower. Then the second was just the uncertainty that this trade war has created. We've heard from a lot of businesses that are saying we're nervous about investing because the environment is so uncertain. And so I think the analysis on the inflation impacts of tariffs, you may bring that down a little bit if this pause endures. But right now, we're still in a highly uncertain environment. And so I hope we can get to a place where there's enduring clarity for markets and for investors and also for central bankers as we're trying to figure out the path of monetary policy.
And Neel, picking up on what you just said, does that uncertainty create problems for risk of inflation, risk of recession that are not dealt with by the pause in the tariffs?
Yeah, the uncertainty is one thing that could cause a downturn in the economy. So uncertainty by itself is not likely going to create inflation, but it could slow the economy down because if everybody pulls back and they don't spend and businesses don't invest, the economy will slow and in extreme cases could even tip into a recession. And so that makes me concerned about the underlying strength of the U.S. economy and the strength of the labor market. The Federal Reserve, one of our goals is to try to achieve maximum employment. So we watch the labor market very closely. The tariffs, on the other hand, potentially can cause inflation. And so, we'll have to see because the president, of course, announced a 90-day pause, higher tariffs on China. How is this all going to play out? Of course, we're going to have to wait and see.
So I want to read from your piece, Neel, with your permission. Given the paramount importance of keeping long-run inflation expectations anchored and the likely boost to near-term inflation from tariffs, the bar for cutting rates, even in the face of a weakened economy and potentially increased unemployment, is higher. You wrote that. Is that still true, meaning the bar for cutting rates in the near term is still very high?
It is, in my mind, I'm only speaking for myself, it is high because we've had 4 years of elevated inflation. If we had had 4 years of 2% inflation or lower than that, then I would be much more comfortable saying, well, these tariffs are probably only going to have a temporary effect on inflation. But given that we've all lived through 4 years of inflation and we're still not back down to our 2% target, that makes me nervous. We talk about this as a potential unanchoring of inflation expectations. And what that means is if everybody expects high inflation, people actually adjust their behavior and it becomes a self-fulfilling cycle. We want to make sure that doesn't happen.
You also write, Neel, and I want to ask you more about this, while market data for long-run inflation expectations have not moved much in recent weeks, there has been a sharp move upward in measures of near-term inflation expectations. And that is important, you wrote, to watch. We were just sort of teasing that out a little bit. What are you and the Fed going to be watching? What should ordinary Americans trying to guess the Fed's next move be watching?
Well, I think ordinary Americans are paying close attention to what's happening in Washington and in policy circles around the world and keep watching all of that. I mean, the fact that ordinary Americans' expectations for what's going to happen to prices over the next year or two has moved up quite dramatically in the last month or so shows that they're paying attention to these trade negotiations and that they understand that raising tariffs on things that we buy means raising the cost and the prices of those things. So I think the public is doing a good job paying attention, and those are the things we're going to watch. We're going to watch Is the job market going to remain strong? Are firms, I think I'm already hearing firms are slowing down their hiring. They're getting nervous. Are they going to restart hiring, or are they going to lay off? That's something also to watch. And then, obviously, what happens with these trade negotiations? What happens with these tariffs? We know what our jobs are. At the Fed, our job is to get inflation back down to 2% and to try to keep the job market strong. Tariffs can push the job market down while pushing inflation up. And that's what's so particularly challenging about them from the monetary policy perspective.
You know, I was watching the financial stations today on cable, Neel, and there was a long discussion about, does this make the Fed more interventionist immediately or not? What light could you shed on that big question?
Well, it's so complicated. It's, with the Fed, we don't want to intervene in markets. We want to let markets correct themselves. There have been some pressures in markets in recent days, and in my judgment, those pressures are borne by economic fundamentals. So if the economic fundamentals get better, then the economy will do better. If the economic fundamentals get worse because the negotiations get worse, then the economy would do worse. We want to prevent big disruptions from happening in financial markets the way we saw during COVID. But I think all of us, we would like to not have to intervene in markets, and hopefully the economy will get onto stronger ground. And I'm hoping that there'll be productive negotiations going forward.
Should I read that as this uncertainty creates a kind of cautiousness within Fed deliberations?
Absolutely. I think many of my colleagues have been out the last few days saying the uncertainty gives all of us pause about what is the right next step. There's a case to be made that if inflation takes off, we could need to go higher on interest rates. Of course, if the economy weakens dramatically from these uncertainty that we've been talking about, that could bring interest rates down. But both of those things are possible at the same time, and that's what makes this such a complicated environment to navigate.
Neel Kashkari, thank you very, very much.
Thank you, Major.